Welcome to our 2022 Fixed Income Market Outlook, an opportunity for active management. I am Jim Jackson, the head of Fixed Income Portfolio Management for USAA Investments, a Victory Capital investment franchise. Our 2022 outlook has four themes. First, we expect positive returns for investors in credit, even though credit spreads or the incremental yield offered to investors to take credit risk are expensive or rich relative to history. Excess returns are returns relative to similar duration treasury bonds. Second, we think active credit selection will be key to performance. Third, we are currently biased towards asset-backed securities over corporate bonds on the short end of the treasury curve and higher quality bonds over lower quality bonds within investment grade credit. Fourth, we think investors should focus on fundamental credit analysis to drive alpha in 2022. Before diving into our 2022 outlook, it is worth a quick review of 2021. Returns were mixed. In general, investment-grade taxable bonds had negative returns as higher treasury yields outpaced tighter credit spreads. Improvement in credit spreads, however, led to positive performance in high yield for both muni and corporates. Finally, investment-grade tax-exempt munis had positive performance on strong demand. Top market risks in 2022 should be no surprise to even the casual observer. Higher inflation, as shown on this chart, and the potential for tighter monetary policy were dominant themes as we closed out 2021. We expect these themes to continue in 2022. We think basing an investing process on these big macro risks is suboptimal, but we look to history to ascertain the prospect for returns based on the current spread environment. Looking at the chart on the left, which shows investment grade spreads between 90 and 100 basis points, which is roughly the level we are seeing in mid-December 2021, you see the positive excess returns to credit happen approximately 57% of the time. Looking to the chart on the right, we are also seeing low dispersion in the pricing of credit, which means there is little difference in the pricing across various credit spread buckets. The current market environment informs our credit outlook. We believe that beta trading credit is over, which started as spreads widened in March 2020. This means that we no longer expect improvement in the overall market to drive returns. We believe the current environment supports three taxable bond themes for 2022. First, we believe high quality ABS offers value relative to corporates. Second, we believe an up in quality bias is warranted. Third, we believe in focusing on fundamental credit research can drive fixed income returns. Finally, on the tax-exempt side, we believe the tax-exempt muni bonds still are attractive for tax-sensitive investors. We will dive further into each theme in the following slides. One of our themes for 2022 is that ABS is attractive relative to corporate bonds on the short end of the treasury curve. This chart shows the advantageous credit spreads of AAA and AA rated ABS, represented by the blue and green line respectively, versus single A corporates. So the conclusion is that we can pick up incremental yield without sacrificing credit quality. Our second theme for 2022 is an up in quality bias. This chart shows the average performance of BBB rated corporate bonds relative to single A corporate bonds when the difference between the two is at specified levels. Single A rated bonds are deemed to have higher credit quality than BBB rated bonds. I will use the left bar to illustrate. When the spread differential between single A and BBB bonds is less than 42 basis points, meaning that the additional yield for taking BBB credit risk versus single A is less than 0.42%, then BBB bonds underperform single A bonds by more than 20 basis points on average, which is the blue bar. The spread between single A bonds and BBB bonds was approximately 40 basis points on December 3rd, 2021. So this is approximately the environment that we're in now. This study also has high persistency, as BBB bonds only outperform single A bonds 42% of the time in the scenario where the spread differential is less than 42 basis points. Our third theme is to focus on fundamental credit research. For this, we rely on our time-tested and disciplined research process. Generally, we are expecting credit quality to improve in the corporate space and for defaults to stay low. Some of the credit Sectors that our research team favors are healthcare, airlines, pharma, and telecom. Finally, for tax-sensitive investors, we continue to find tax-exempt muni bonds attractive. There is still a lot of muni-focused stimulus spending coming, and economic numbers continue to improve, both of which are supportive of tax-exempt credit. So what are fixed income investors to do? Here, our approach is consistent. Investors should focus on generating income. Investors should ensure that their duration exposure matches their interest rate risk tolerance. Investors should not invest based on macroeconomic or interest rate forecast. And investors should stay invested in fixed income as an asset class, as it is a proven portfolio diversifier. Thank you for listening to our 2022 Fixed Income Outlook.